The current economy is stuck. Job growth and wage growth are limited, and the housing market is just starting to move again. Today, we're going to discuss this stuck economy and what you need to do to get ahead. So the economy seems pretty stuck currently.
Because it is. Yeah. There's a lot of uncertainty.
Uh-huh.
Right? Like when there's uncertainty, people take their foot off the gas. They hit the brakes a little, right? They're starting to feel inflation.
Starting to feel it? They've been feeling it.
That's true. Yeah, you're right. I think that they've been feeling it, but also they've made sacrifices. Things have gone up, and so they've switched, right? They've switched their habits, switched their routines, and places are feeling it.
Well, it's so interesting because, you go certain places and they say they're feeling it, but then you go other places and they're jam-packed.
That blows my mind.
Mm-hmm.
We're seeing it on site with our renters, right? We have 10,000 renters. One of the things we're seeing is less turnover, right? People are staying put. There's a little bit of uncertainty. You have a tendency to be a little more transitional, I think, when there's income coming in. You got multiple sources of income. Also, there's a lot of things in front of people right now that are concerning them. So it's like that Uber driver we were talking to, he said that, Waymo is in Phoenix and he's afraid that, Waymo is taken away from the Uber drivers. And it's true. It's taken away from the food deliveries and stuff like that. And if you guys don't know what Waymo is, it's driverless. And we're not the only city, but if you're an Uber driver, and the guy specifically said, we can't compete in the areas that they're testing in. And so they moved to the fringes. And so you start to see things like this. You start to see things that people have been doing I call it side hustle money, to try to get through some of that inflation. And I think they're a little bit concerned. And, that's just one example.
Yeah, when I was in Santa Barbara this weekend with some friends, there was definitely a lot of shut down retail, a lot of things for lease that weren't being leased out. And, I thought it was a little bit interesting, right? Because we were right in downtown Santa Barbara. So you would think that would be a pretty busy hub, and it really wasn't that busy.
Well, look how people shop now.
Mm-hmm.
I don't know about you, but actually, I do know about you. I don't know how many boxes. The other day I looked, we had at least 30 boxes sitting in front of our front door. I'm not joking.
I hadn't bought anything
30
all summer.
Well, you were hey, I went kind of crazy on Amazon. Well, all right. There was 30 boxes.
Mm.
All right. Come on. So I guess the point is that normally what would we have done? We would have said, let's go look for a sport coat, or let's go buy a pair of socks. Let's go whatever. Let's go to this sports store. Let's go get our running shoes. Or now it's we're just so darn spoiled. Same thing with groceries. The point is, however, that the retail, they'll call it the bricks and mortar, is stressed because let me just walk you through the math. If you had a Safeway, let's say a big Safeway or Smith's or Albertsons or pick a brand, it doesn't really matter. And you used to have, 1,000 cars show up, in the morning, let's say. And what they do is they show up and they use the dry cleaner next door. They use the post office next door. They fill up their water jugs. They go get a haircut, whatever it is. There's little yoga studios or stretch labs or whatever you want to call it. The entire center is affected when traffic stops.
Mm-hmm.
And that's what you're starting to see, and these specialty corners, these specialty streets that used to have extremely high rent. I think the 1% is still shopping at those, keeping the, I guess the rich, but I'm sure that they're affected too.
Yeah, I think everyone's a little bit affected, and people start cutting out expenses, that aren't essentials. If you look at inflation as of August, it is still 2.9% year over year. That doesn't even count the amount of inflation, we had from 2020 till 2023, which was really high. And then you have your job growth, and it's nearly stalled. We've only added 22,000 jobs in August. And that's been really little change since April because, they went back and did all the revisions.
And the revisions are just beginning because, we had dinner with Jim Rickards It was a blessing having him in town a couple weeks ago. And he basically said that a lot of the models that the government uses, including the Bureau of Labor Statistics, are old. The models are old. The financial models where they actually calculate whatever it is they're calculating are old. And he went into all kinds of detail. I would encourage you guys to watch his podcast with us on YouTube. And it's just fascinating the level of detail he went into on this. And so what's happening is when Trump fired their director, which is not very long ago, he said they're going to rip the Band-Aid off, put this new model in place, and then the numbers will be what they'll be. And I want to say that we've already seen almost a 900,000 person adjustment, something crazy. And I think we're just beginning there. And so unemployment went up from 4.1 to 4.3.
And the Fed really likes it below 4.
Yeah.
Ideally, definitely below 5.
They do. But I just want to point out that from 4.1 to 4.3 is about 400,000 people. So these are not, when it's easy to say 1%, or well, I should say 0.01%, it doesn't look like much, but it's a lot. 400,000 people is a lot of people.
Yep.
Right. And so it's something to watch as we move into this next piece.
Yeah, and you have to look at the cost pressures people have right now. Median home prices used to be 3.5 times income in 1985. Now it's 5 times the income in 2025. And rents, which were about 30%, are now 32 to 35% in most markets, even seeing 40% in some of your more expensive markets. So that really does also affect, what people can afford if so much of their expenses are going to these things they need, like housing, groceries, power, electric, like car payments. They don't have as much money to go get a massage or to, go to a concert. But you have the other side of that where, my friends and I were going to go to Backstreet Boys concert at the Sphere, and it's totally sold out, and tickets were over $1,000 a piece. So it's so wild. It's like this weird
$1,000 to watch an old band.
And I didn't want to go because of that. I was like, it's too expensive. I don't want to spend that much money. But it's so crazy that that's sold out and they had to book more shows when you have people dealing with all this pressure on inflation. It's just such a,
because that extra $1,000 means that there would only be 20 used boxes from Amazon instead of 30, right? You'd have to make an adjustment somewhere.
Well, if you're spending $1,000 on tickets, then that doesn't even cost the trip, the flight.
Don't forget about the hotel room,
the hotel, all of it. So it's just like, it's so confusing to me how you can have, people that, are having trouble paying rent, and then you have people that are going to these concerts. I mean, it just seems like, that's why the economy is so confusing for people. Because when I talk to people, they're like, the economy can't be that bad. There's like a line out the door at Starbucks every day.
Say something that happened to me that I couldn't believe this. So, but way back, this is going back a little while, but I went to an NBA All-Star game. So there was a time where the director of the NBA was kind of having us do some stuff. Me and Robert Kiyosaki, we were doing some stuff for the NBA. We're going to their offices in New York. It was a flipping blast. Anyway, so we would get invited to these NBA All-Star games. And so we were staying at the hotel where the players were, which was cool. I back in the day, it was on the Strip. And I remember going downstairs, and they had raised all the tables to $100 per hand. This is going back a little while, right? $100 per hand, and every table was packed. And I was sitting there with Robert, and of course, we both have resources. And I go, "Do you want to pay $100 per, for hand to table?" He's like, "No." I go, "I don't either." So we took a cab, and at the time, down to, I think it was Binion's down in Old Vegas, and we ended up sitting at a blackjack table and drinking some beers and shooting cards. But we had a fascinating conversation because there's no question in my mind that the people actually sitting there at the table could afford to lose $100 a hand. It was packed. And I think what happens is, and the point of the story is, there's a pressure around people to kind of keep up with the Joneses. Mm-hmm. And I think that's what we're kind of seeing now is, these things like $1,000 a ticket for Backstreet Boys, where's all this money coming from? And is it going on? Is it increasing their debt?
Well, that is the question. Is it because they're putting it on a credit card? Are they putting it on a home equity line? Do they just have it? Are they just paying for it and it's fine? It's very confusing. And, the Backstreet Boys is a good example, but so is, the line at Starbucks every morning, because these people get like a $6, $7, $8 coffee every single morning. And you times that by 30, that's not cheap. So it's kind of one of those things where I think people question how bad the economy is and if we're really in a recession based off of these spending habits that they're observing with their own eyes.
And that was my point, is their habits, right? Mm-hmm. And they don't stop their habits because they don't want to stop their habits, right?
But do they have to, is the question. Is the economy really so bad that they have to? Or is the economy not as bad as we think and people have this extra money?
I think there's something bubbling under the surface. And I'll tell you, I won't say who, but I had a conversation with somebody that's in the wealth management business and the life insurance and, disability insurance and all that kind of stuff. And I asked him, I said, what's happening? He goes, delinquencies are up. People are ignoring their notices, and some of these policies are in jeopardy. Now that's just one small example, but what we're starting to see is people are, they're gonna go back to the basics, right? Mm-hmm. They're gonna need a car in some cases, not every case. They're gonna need a place to stay, and they're gonna need food, but they're gonna pull back, and we're already starting to see it. Look at the travel numbers, and we're already starting to see it. The cruise industry has already posted this, and so you start to see things. And one big indicator that you and I flushed out, not long ago, was the average age of a home buyer. Yeah. I mean, that's in the
but that's a big saving thing. Just because somebody doesn't buy a home doesn't mean that they're in financial distress.
No, but think about the indicator where it's I think 12 years more. So you just go back and look at history where people first came into the single family market. It was always in the 30s, late 20s, early 30s, and now it's in the 40s. And so why is that? Well, there's a whole generation, a decade of people that are now going to have to wait. Now, these are averages. Don't get me wrong. I get it. But that's a big deal, because think of the wealth building that happens in that 10-year period.
Yeah.
It's a lot. It's a lot of money. I mean, we'll put it this way. Like, just use yourself an example. Look how your net worth personally has gone up in the last 10 years. Mm-hmm. It's a lot.
Yeah.
We don't have to say how much, but I know what it is. And I'll tell you what, imagine if you would have just got started now.
Right.
And this is my point. So, so not getting into the game is a big deal. And when you said, what people are stuck in, this is part of it.
Well, but I also think, what's going to be interesting is I was talking to somebody and they were saying that those buy now, pay later, how
that's in trouble.
They break your payments up into like 3 or 4. I mean, literally, it's so ridiculous. You buy something like $8. It's like, do you want to break this up into 4 payments of $2? And, literally. And so, but those don't count against your credit. So it never has.
I think
it's changing. So it never has. So you could do that, and it just really wasn't part of your credit, and they never used your credit. They didn't run your credit. It was like almost like they gave you a little balance and then increased it as you would pay it off. But now I guess it's going to count. So that's going to be interesting when it hits people's credit, because when you apply for car loans and you apply for all these different things and you have your debt to income changes, then that can be a problem for people. And then already you have the student loans that were reactivated. And I'm seeing that a lot working with buyers is, hey, I want to buy a house. Awesome. Why don't you get pre-approved? And their credit comes back at like 550. And it's like, what? Why is my credit so low? Well, it's because they haven't been paying their student loans and they kind of thought, oh, I don't have to pay these. Like, it's happening a lot with like a lot of people that you would look at as responsible, and it's ruining their credit because they're not paying their student loans. So, you have that too on top of this other credit issue.
That's a good point. And I think that, these higher rates, like there's a hangover period, like people keep their cars an extra year or two. They keep their homes an extra year or 2 or 3. What do? They go to Home Depot, they go to Lowe's, they start doing, those little projects around the house, instead of going and upgrading and buying a new house. So all of that stuff, then that, by the way, could get reignited with lower rates.
Yeah, totally.
Right now, people are staying put. The credit card debt is, gosh, last time I looked, it was like 1.5 trillion, something nutty. And I remember it wasn't very long ago, it just went over 1. So it took forever to get over 1 trillion as a country, but now it's exponentially just going up like crazy. So I think this is kind of the first stage is people, they haven't quite pulled back. They kind of finance their future. That's kind of the first step. They keep their habit. They go to Starbucks and they put it on their card, right? They go to the gym, they put it on their card. Like everything's the Netflix and the Apple, and the different kinds of services, the streaming services, they're all on their card, right?
Right.
It takes a while for them to peel them off.
Well, yeah, you're right. I'm sure that it does. But there are pressure points right now that's also creating this stagnation, because part of it, to your point, is that they maybe have to change their spending habits because they can't afford it. But then the other part of it is they're like quick to make any financial decisions because they don't know what's happening. We just talked about this, before when we were going over topic ideas, like, should I list my house now or in the spring? Like how's the real estate market going to be right now versus the spring? How's this going to be? How's the stock market going to be? How's crypto going to be? Like, people don't know. So it puts them in this holding pattern.
Yeah, well, I think if you take a look at really, real estate's been flat, crypto's been flat, wage growth has been flat.
The last few months, yeah.
Yeah. Inflation is up, right? What's still in the 3s, and it's been higher. But I think people feel that a little bit more, and all of those things kind of keep people stagnant.
Yeah, I mean, right. You have that inflation, you have tariffs. We keep hearing that tariffs are going to increase prices. We have not seen that yet. I do think that they will. Some people don't think that they will. But either way, we just haven't seen it. In fact, we don't even really have super solid tariffs right now. I mean, things are, still going to the courts to even see if it's legal. We're still negotiating with the different countries. So there's really we haven't seen anything with the tariffs yet, but I think it's on a lot of people's mind. It's on the Fed's mind, when it comes to what they should do with interest rates.
Yeah. And, only having 22,000 jobs should be like, that should raise some eyebrows.
Yeah.
I mean, like, and the other thing, I here we are, and call it heading into the last quarter of the year, right? And what do people expect at the end of the year? They typically expect some kind of wage growth, some kind of employee review, right? And so what the employers are going to be doing is they're going to be looking at, in fact, I just had a conversation today about this. I went through our whole company, right? How many people we have in IT, how many people we have in accounting, how many people we have in marketing, how many people we have in HR, how many people we have in all these different departments, right? And not to eliminate at all, but just to look at what everybody's doing and to try to see how efficient are we, right? And why am I doing that? I'm doing that because our company is also feeling the pressures of the inflation and all the things that are, hitting everyone. It's not just hitting the people. So why is that important? It's important because as an employer, you're going to be faced with a decision, and that is, you have a lot of options out there with people on the market, and you also are faced with what are you paying people today and how much do you increase them. So so while that's there's some cross currents going on there, the reality is that the employee is at the mercy of the employer as they head into this next year.
Yeah.
And so that's all coming down the pike here in the next 90 days. So let's just say you're an employer or you're taking a look at things right now. We're already looking at our 2026 budgets, right? What are we looking at for income? What are we looking at for expenses? Just as you should. That is the right way to run a business. And then that decision oftentimes drives what you can do with your current staff. And then, of course, you got to say, well, if they're credible performers, you don't want to lose them either, right? So there's all these things that go on, and so the point of all of that is that the employer and the employee, this is going to be an interesting fourth quarter, because the employee has to wait kind of to see, what kind of an increase am I going to get next year?
Well, I think they're all just going to assume they're going to get their standard.
Maybe. And I guess that is kind of where I was trying to lead you, actually, is if they feel that way, if they feel like, hey, like the company's not doing as well, or, and maybe the companies are a little more transparent than others. You just don't know, but you all really are at the mercy of how that company's doing.
Well, we're going to recessionary times, and we haven't for a long time. So the company might not be able to give the same raise that you're used to getting. I mean, they might not.
Right.
Maybe you get more if they're, a company that does well in recessionary times, but you do have to think of that. You can't assume.
So this is exactly my point. So if we know right now that, let's say a standard, wage growth raise is what, 3, let's say. What's inflation?
Right. And 3. Right now it's inflation is 3.
Is at 3.
Yeah.
So you have wage growth at 3 and you have inflation at 3. That literally means that you haven't moved financially.
But if your company can't give you a raise at all and you have a 0% increase, then you're behind.
That's right. And that's kind of the point. And I think that, when you start to look at what a stuck economy means, that's what it means. And that's why I brought up the Waymo thing, and I brought up the side hustle thing. Things are pulling back. People are pulling back. And so I think that a lot of time, and then the other thing that was kind of an anomaly was the crypto craze, right? People were just like, it was all over the map, and that's kind of flatlined a little bit.
Yeah, right now it is flatlined.
So that's, I wouldn't say it's gone away, but it's not producing what it was, right? So,
well, people don't have necessarily, at least from the United States, because I know crypto is worldwide, but in the U.S., people don't have that extra money to put into crypto is the thing.
Yeah, and so that's what I think, and I think if we start to see rates go down, which certainly I think Trump's going to beat out everybody until they do it. Then you will see. That always drives consumerism.
Yeah.
Right? Always, every single time.
It does. But if you mix it with unemployment, then that does get trickier.
Absolutely.
If the rates go down and it doesn't spur the growth that they need it to spur, that could be not great, because we went over on the live today. You guys should check it out if you haven't. The recessions throughout since the Great Depression, and how the Fed got us out of each one, and it was all a little different. And they made some mistakes, so they don't always know what they're doing, and it's not the same textbook every single time.
Yeah, and I think, I love that live today that we did, because it essentially, as the economy changes with unemployment or inflation or interest rates or whatever, there's something else affected, right? Mm-hmm. And so the one thing that's for sure under Trump that it sure looks like, because he did this in 2016, is when he lowered rates, that it does spur the economy. So now he'll be long gone by the time the asset inflation, that you get from cheap money, because that's what happens. You start to see more consumerism, right? And that is that increases GDP. All that stuff helps by having the lower rates.
Yeah. And then interest rates is another pressure point right now, right? Like so people are so confused because they lowered rates, but rates didn't really lower. Yeah. But rates lowered prematurely. So they went down about 0.5 point since about a month ago, but they didn't lower again right after the Fed lowered them, because, lenders are smart. They want to kind of get ahead of it to get more sales. And then, there's not a big move once they make it. Now, if they think they're going to lower it another 0.25 point before the end of the year, they might preemptively lower it another 0.25 point, here in the next month or two. But that's just kind of where we're at right now. Is rates are closer to 6.5% now instead of 7%, which is good. But they're still, as you were saying earlier on the live, they're not really high because they're, traditionally, but they're higher than we've seen in a long time.
They're higher. They're perfect for me They're average for me, but they're really high for you.
Yeah, they would feel high.
Like in Danille's lifetime, they're high.
Yeah.
In my lifetime, they're extremely average. If you go back in history, which we did on the live today, it's super clear. You can tell that each time we've had an recession, what the Fed does, right? It's super clear. And so, we're technically not in a recession.
Well, so they say.
Yeah, so they say.
So they say. I think that we are in a recession, but they always call out a recession long after we're already in one.
Well,
but
I can tell you this house is not in a recession.
Right.
I see these boxes come pouring.
Hey, stop with the boxes. Okay, so what does stuck look like for everyday people? Because I think that this is interesting. So in the housing market right now, it's very interesting because I'm working with buyers, I'm working with sellers, and I can tell you buyers and sellers are not motivated. Like nobody's motivated. Nobody cares. Like a buyer's like, well, maybe I want to offer on this house and maybe I'll wait or maybe I don't. And then a seller's like, well, this is a decent offer, but I don't want to take it. I want to wait and see if we can get a better offer. So everybody is
spoiled. Everyone's spoiled.
Well, but everyone's not motivated because a seller, if it's not vacant, if it's vacant, it can be a little different. If it's not vacant, they don't really care if it sells. Like they're at a 3% rate and they don't care if it sells. A buyer wants to buy, but is like, but I think prices might even go down further. So maybe I'll just wait. Like, no, it's so funny. It's like nobody's motivated. Nobody's like, I got to buy right now or I got to sell right now. It's just very stagnant. So you can see that continuing to happen because these sellers are not in trouble. And that's the biggest thing. And these buyers that are looking do have the money to buy, whether they're an investor or whether they're a first-time home buyer. Like they have the funds to do it, which is why they're looking, but just nobody's motivated because everything's kind of stuck. And everyone, sellers are thinking maybe in the spring prices will be higher, so maybe I should just wait to sell. And buyers are thinking maybe in the spring prices will be lower, so they're just waiting to buy. So it's just very interesting.
There's a lot going on in your head right now.
There is. It's funny. Yeah.
Jeez, that's a whole mouthful.
But if you talk to a seller, they think prices are going up. You talk to a buyer, they think prices are going down. So it really is very interesting.
Now you guys know what it's like. I will tell you this. I think everyone is hanging out and looking in the rearview mirror.
Yep.
Right. And they're like, my house was worth X. And there used to be a time where there was all these people that would clamor to buy it. It takes a little while. It takes a little while for them to realize that we have a little bit of a new normal.
Yeah, and buyers too.
Absolutely.
Funny. I know I've told a story before, but it just happened again today. I had these buyers call me. They're like, we really are concerned something's wrong with this house, but we're kind of interested in seeing it. I go, okay, wait, how long has it been on the market? 39 days. And people are just used to stuff selling.
This is my point.
Since 2020, things were flying off the market. If it's not listed for more than 15 days, people think something's wrong with it. But really, average days on market right now is 60-some days. And I watch houses. Houses will be listed for 60-some days. They do a $5,000 price drop, and voila, it sells. And so it's not like if it hasn't sold in 60 days, it's not going to sell.
Like you are lucky if you could only have a home on for less than 60 days, and that's actually the point I was trying to make is that's not a balanced market. The MLS has a history of saying that it's 4 to 6 months, somewhere in there, right? There's a range, obviously, by city and all that kind of stuff, but 4 to 6 months is what's considered healthy. And right now, the average is 60.
Yeah, 60-some days.
So that means that really it's still a little bit of a seller's market. And then, of course, the point that you made is the buyers are sitting there waiting for these rate cuts. The Fed doing that quarter point that they just did, all that would do for me is, I'm going to see where this goes in the next month or two because, why wouldn't you? Why wouldn't you take a look and say, why would I refinance now? Because maybe I'll just refinance in the Q1 of 2026 and just see where rates go. Because it sure looks like everybody's talking about, Trump's gonna put all this pressure on, and Powell's gonna be out of there next May, and there's gonna, he's already trying to stack the deck over there. I don't know if it'll all work, But the reality is he's made no bones about it. That's exactly what he wants to do.
Yep, absolutely.
Okay, so if you're sitting there and you want to refinance or you want to buy or you want to do anything and you got a president that's beating on the chair Fed, which I don't agree with, but he's doing it anyway. He's crystal clear on what he wants. Then and you're sitting there saying, well, maybe I'll just wait till next year.
Yep.
Right?
Yep.
Fair.
Totally.
Okay. I think there's a whole bunch of that happening.
There is. I think the $1 million question right now for me in my mind is, as rates go down, I know sales are going to pick up, but do prices go up, right? And so, you think of that.
Typically, not initially, but typically there's a lag there. So, and I do want to be clear. Each quarter point does do a little bit.
It does. No, it totally does.
It does do a little bit, right? And there are people that take action just with just these little moves, and you should be doing little moves too.
Yeah.
Because the last thing we need is a big, drop, right?
Yep.
And I don't know if I'm Powell and I'm looking at the economy, I'm probably okay with under 3% inflation. Their target for unemployment is right about where they want it. And interest rates of, call it 6.5, not bad. On the commercial side, we just did a deal at 4.74, with an apartment deal. So that's pretty good money. I mean, it's not 2 or 3% like we used to see. And construction costs or construction debt is still high. But for a single family, you're still 2-3 points higher than it was.
Yeah.
Right. And that's what's holding everybody back. You've got a tremendous amount of equity sitting in American housing right now. Like I think I read it's $12 trillion. So if that gets unleashed, holy moly, that I'm telling you what, that could be very interesting. That refinance market, that money's going to come pouring out. It's going to buy trailers. It's going to buy boats. It's going to remodel kitchens. It's going to buy new houses. It's going to pay off stuff. I mean, that's what essentially.
Well, yeah, and explain that really. I mean, if somebody's in a 7% rate and they can refinance into a 5% rate, then that's going to then free up their spending ability.
Well, yeah. So here's how it works. Like, let's say that let's say somebody is in a 5% rate today, and today rates are 6.5, but that person sitting in a 5.5 rate has $300,000 of equity or $400,000 in equity. When the rates come down below 5, let's say, they'll refinance. And what they'll do is they'll do a cash out refi, because that they'll be able to get, let's say, a 70% loan to value, 65% loan to value. I guess it'll depend on a number of factors. But the point is they'll be able to scoop of that 100 to 100.5 out of there, cash out, tax-free refi. Tax-free because it's not a sale. It's debt. So you're basically just replacing an old loan with new loan, and at a higher amount. But if the rate's lower, your payment might not change that much. So Ross and I have done this before. It's phenomenal when rates are going down and your values are up. You can literally it's like a cash machine. You just keep taking the cash out, and your mortgage payment doesn't really change very much. That could happen for a lot of people. And for people that just bought, recently, that could be significant because they have had an equity increase since the pandemic.
Yeah, not even just that, but just even if they're able to lower their rate into something that's more manageable, because a lot of people overstretched on their mortgage hoping for lower rates. They were told by a lot of realtors that, you can refi this in a year, and they were told that in 2023, and so they're waiting. So when they're able to do that, it's still going to free up their ability to spend month to month, because they're going to save a few $100s a month on their mortgage.
And then here's the other thing. If they cash out, I always find it interesting, like for a lottery winner or somebody gets a bonus or maybe a tax refund, does that go into savings? Not normally. Normally, they're like, I got this extra cash. I can go.
Yeah.
I'm not saying in all cases. What I'm saying is they go upgrade their lifestyle somehow. They buy something that they wanted. I'm not saying they shouldn't. I'm just telling you about behavior. And
but if they do a cash out refi, they have to have cash. And I would say that prices from 2023 till now have trended to be softer than what people bought
That's
in
true.
2023.
But I'm saying if they pull cash out and use their house as an ATM, let's say they pull 50 or 100,000 out, right? What do you think? Where do you think that money's going?
I just don't think people do that right now, personally.
Well, no, they don't right now
because
because rates are high. That's for sure. Well, what if they go down? This is what we're talking about, right? Then potentially, where does that money go? It does not go into savings.
Right.
It does maybe initially, but then it goes out into the economy, and that is kind of the point, right? And that's all I'm saying. Yeah, obviously, everything has to work. Yes, the home has to be higher because you're not going to have a cash out refi. But in the case where I'm talking about a cash out refi, then there's money that's coming out. And the point is, where does that money go? It does not go into their savings account for very long. That's my point. What they do is they look around and they go, I want a motorcycle. I want a new car. My car is 7 years old. We need new cabinets, like whatever, those kinds of things. And so that's all I'm saying. And then that money starts to flow out into the economy. That is what happens when rates go down.
Yep. And then the other thing in a stuck economy is you have stagnant wage growth, and then you have continuing increased prices. Because if it's just 2 to 3%, you're still going to get that strain, and you're just not going to get the wage growth that you thought you were going to get. So you don't have additional money to spend.
Without a doubt. I firmly believe that's where we're heading. We're heading into stagnant wage growth.
But would that be stagflation then? Because you have inflation with stagnant wage growth?
I guess, stagflation by definition is a negative GDP with inflation, right? And so spending's down, inflation's up. I think that's what it means.
So that would be, that's what it would be if people didn't have the money and then inflation continued, right?
I guess the question would be that if the Fed's target rate is 2 and it's at 2.9, is that high inflation? I think you can make a case that it's higher than 2. So is it high? It's certainly not like it was in the 80s when it was double digit. And it's certainly not like it was in 2022 when it was 9.1 in June. So is it high? I don't know. It doesn't seem high. But what if inflation ticks up to 5, 6, 7, 8%, then I think you got it. I think you're right.
Well, yeah. If they are going to lower rates, there's a possibility that inflation could then go up based on the rates.
And then everybody's still waiting on this tariff lag, right? We don't know. Trump keeps saying that everyone else pays for tariffs. It's funny how people are divided here. Some are saying it's going to trickle through the economy. Even our conversation with Jim Rickards the other day, it's not going to trickle through. Well, I thought that's very interesting. It seems from a common sense standpoint that it would, but it's some very, very smart people say that it won't.
Yeah, it should be interesting to see, how it all pans out. So people always wonder, what do you do in a stuck economy, right? Because everyone just feels like everyone's just waiting, right? So the things you definitely want to do is avoid new high interest rate debt or any kind of debt that's not fixed.
Yeah, guys, fixed rate debt, as always, right? Be careful of those floater rates. We just don't know where it's all going to go. I think the interesting thing is, we've had, for the first time in a long time, since I remember, we've had really pretty cool savings rates, right? 4%, 5%, these 1 month T-bills. As rates go down, if they do go down, those savings rates are going to get worse and worse and worse, which is really going to be interesting, right? Especially because, for the longest time, we were sitting at 1% for savings, which is nothing, right? What basically just doesn't incentivize you at all. Why would you have 1% savings and 3% inflation? You know what I mean? It just shows that saving doesn't work. I think the key is this. There's a couple levers that you have to watch. One is if you are sitting at 3 or 4% inflation, it could be even higher. You have to make sure that the money that you have is beating inflation. If you want to be ahead of inflation, so in other words, inflation should be your target. If you just hit it, you're actually not moving. You're just staying stagnant. And to your point, if it's less, then you're moving backwards. If it's more, then you're actually beating inflation. So I think one of the things that you should always be looking at are things that move with inflation.
Yeah.
Right? What are some of the things that are going to move with inflation? I think that's very, very, very important. So we're starting to see that with silver and gold, price of oil, even though oil's, I think, manipulated a little bit. But you do see it there. You see it in the cost of housing. Think of a 2x4, think of roof tile, think of appliances, those kinds of things. Those are all moving with inflation. So buying below replacement cost would be something you could do on the real estate side. But I'm not advocating that you invest in silver and gold, but I'm just saying that, just watch for those kinds of things that, can move the opposite direction oftentimes. As the government continues to print to pay for things, whatever it is, entitlement programs or Medicaid or Social Security or, those kinds of things, that's a cost, right? And so what happens, with the economy during that time? What happens with some of those other things? Those are all very, very important things to watch. And I think that, anything that's inflation adjusted is probably something you should be focused on.
So if you're a home buyer, let's talk about home buyers at this time. Don't buy things you can't afford. So don't buy a home you can't afford. Don't assume that rates are going to go down. Don't assume you're going to be able to refinance, because if your home goes down in value and you go to refinance it, you might not be able to without making up the difference. So make sure whatever you're buying you can afford and that it's fixed.
Yeah, I would take that one step further and just call that a depreciating asset. So, I know a number of people, it might surprise you, but both Danille and I almost never buy a new car. I have one time, brand new. Okay. And why do I do that? Just because I grew up kind of frugally. I always like to buy it a year or two old with low miles. So that's just me. But most of our friends buy brand new. So you buy a $100,000 car. You guys already know that thing's going to be worth 80 to 75 a year later. Okay. That means you're underwater for the first few years. Those are little things, but they're big things. Right. And so, you don't want to be in a situation. I have been in so many scenarios where I bought a car and I've actually sold it for at or more than I bought it for. And so you start to look at depreciating assets, whatever those are. And, sometimes these big purchases that you finance, you got to be careful of.
Yeah, so you don't want to buy things you can't afford, but when you're buying a home specifically, the home also might go down in value temporarily. So just don't assume you can refinance next year.
But just make sure you have a fixed price, like on your mortgage. So if it's fixed rate, it's okay. If you can afford $3,000 or $4,000 and the home goes down, who cares?
Yeah.
Right. You just keep paying the mortgage.
And you have to remember too, that if you wait, lending can tighten. So if we would go through something, there might be a time where you can't get a loan that you could get right now because you might lose your job, or lending may tighten where you need more down than you do right now, or the credit, requirements may tighten. So just remember that can happen, as the economy moves forward into a recession.
I think cash reserves, I think you guys should focus on cash reserves, whatever your number is. I know some people have 3 months operating expenses. I know people that are doing 6. I know people that are doing 12. I think you have to have a target of saving and have a little bit of cash for things that you might not foresee, right? And that's and of course, if you're in a position to be able to buy things, then I think that you might want to consider some liquidity events now, build up your cash reserves, and start to take a look at deals that could be coming down the pipe in 2026.
Mm-hmm. And if you're buying a home right now, look into seller concessions. There's hardly any deals that are closing without them. Ask for 1% to 3%. You definitely might be able to get them. If you're a renter, consider rent to own right now. You might want to approach your landlord and see if you can negotiate a rent to own situation, because maybe they're looking to sell and you don't even know.
Yeah. The other thing on the renter side, because this is an area that we are in, there's a tremendous amount of new product hitting the market right now all over the country. And they offer anywhere from 1 to 2 to 3. I've even seen as high as 4 months free on a 12-month lease. Now think about that. Just think about that. Like if it's 3 months on a 12-month lease, that's essentially competing with, something that's 20 years old. the same rent, right? You know, if you use a discount, so you're upgrading into a brand new place, or you can literally, if you're in a brand new place, you can move laterally, pay almost the same or even less by capitalizing on that rent concession from the developer. So pay attention to, you know, where there's soft rental markets, because in soft rental markets you can make really, really good deals. I've seen people come in and they just pay the first month's deposit, and then they don't have a rent payment for a few months because of, you know, the landlord's just trying to fill that unit, and so they're looking for people with good credit, and so it's a really good time as a renter to be able to look for deals.
So if you're an investor right now, like we are, you know, you definitely want to be underwriting conservatively. You don't want to assume rent growth or appreciation. You just want to focus on how much you need to put down to make a cash flow.
Flat rent growth and high expense growth, guys. Let me tell you something. Property taxes, insurance, utilities, labor, you know, fixed goods, you know, that you would buy, like the price of a refrigerator or appliance, or that's all up. All of that stuff up. You know, you're starting to see, a lot of you are probably starting to see these increases in HOA fees. That's a result of prices going up with the landscaper or the you know, the road repairs or whatever it is. You know, all those little things, they start to creep up, and then so they pass it back to the homeowner. So for those of you who are shaking your heads, yep, that's happening, and we're seeing that. That's exactly what's happening if you're not in an HOA. It's just prices are going up.
Yeah. And so you want to also consider alternative assets, you know, while you're holding your money. You know, savings account rates right now are, you know, 3-4%. T-bills are at 5%.
That's pretty good.
Decent, right? It's keeping you at least moving with inflation.
Yeah, you guys, the key here is just to make sure that your money's making more than inflation. And that is really, really, really important. Things like gold, things like silver, things like crypto, that's speculation. That's like throwing a dart at a dartboard. You hope it goes up. Doesn't mean it's going to. You have a percentage there, I think, for sure. I certainly do. But you do not bank on it.
Yeah. And then you have to watch for distress. So like we were talking about a few weeks ago, it's not a distressed market, but that doesn't mean there's not distressed sellers. So, you know, keep your cash ready to find those deals where the seller is distressed. I run into them all the time. You know, I just toured a home this weekend with a buyer. It was a half-finished flip. You know, she didn't want to finish it, but if you do, that's a place you can get a pretty good deal, right? So there are people, especially people that are flipping homes that are vacant, where people are more motivated and could be distressed, and you could get a good deal that way.
I always like to say there's a big difference between stress and distress.
Mm-hmm.
So
yeah,
there's a big bridge between those two things, right?
Well, and as as things sit, the stress can turn into distress. Like I was following this one home. It's been listed for, you know, $650 forever, and it was slowly going down, and now they just sliced it to $550. Like and it was a flipper. It's a beautiful home, but it's one of those things where the stress turned into distress, right? Because
let's explain why. Because that flipper is using hard money. They're using short-term money. Again, back to the basic fundamentals. They're using somebody else's money at high interest rates for short-term, and there's been no buyers.
Yep.
So they renovate it. They probably bought it, who knows what exactly, but probably in the high 4s, low 5s, dumped a bunch of money into it, and we're trying to get a quick buck. Well, didn't happen. So they lowered it. Why would they lower it $100,000? Specifically because tick, 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 tick on that short-term money at the high interest rate. And
I have a feeling that exact price that they lowered to are probably their break even, right? They're just saying, screw it. We're not even trying to make any money.
Right. Yeah. And you know, and so that's distress.
Mm-hmm.
Stress is, the property's been listed for 90 days and we've got nobody looking at it.
Mm-hmm.
And distress is they're still paying the payment to that hard money, let's say. You know, they've already spent the money in there. They're not getting any tours and, you know, all the stuff that goes on for you to try to move a piece of real estate like that. Then that turns into distress where you actually lower it to $550. And then after that, check writing time. So that's the next step. And so we are seeing deals like that.
Yeah. Yeah. And we're even seeing it on the single family home side, but we're seeing it more at the flippers because The normal, just normal home buyers are in 3-4% loans. It's not as stressful, but it can be depending on their financial situation if they've already moved. But, these homes that are at 15%, these slippers, I mean, it's a big deal.
Yeah. Yeah. And so if those people have a gun to their head, it's the high interest rate debt. Mm-hmm. That's what's going to do it, guys. Like if you're sitting at 2, 3, 4%, like Danielle's got a deal that's 2.8% or something, mm-hmm. right? Like she goes, I can't sell it because
I want to sell it, and I'm probably going to sell it eventually, but there's just no motivation for me to sell it right because it's such a low rate.
Your interest rate is so low, your mortgage payment is so low, you're cash flowing like crazy. So selling it just to get the equity means that you're moving it and you're paying more somewhere else. So, and then of course, harder to do the math where it moves to. So you're not unique in that, you've got a lot of people just sitting at these low rates.
Yeah, absolutely. And the last thing that's stuck right now is your career and your income. So the biggest advice that we could give you is you need to really dig deep into AI, unless you're kind of a manual labor job. But if you're doing anything behind a computer, you really need to understand AI.
Guys, I'm telling you,
it's coming.
This is something that, take it from an old guy. Like, it's not easy to actually pour yourself into ChatGPT and figure out what an AI agent is. And if you don't know what an AI agent is, I already know more than you, which is not a good thing, by the way. So I'm telling you, you have to do this. This is a game changer. There's going to be people that know AI and people that don't know AI, and it's going to be expected. And so you have to jump on board. I always laugh because my mom, I bought her an iPhone and she never used it. Then I bought her an iPad. She never used it. Then I bought her a computer. She never used it, right? Like she's so old school, writes everything down. It's called a Luddite. They just stay where they are, right? For whatever reason, obviously my mom, so I better stop right now before I get in trouble. But the point is, there are people that stay right where they are. They're still reading a newspaper every day, right? And again, I get it, but things do move, and you need to move.
Yeah, absolutely. Well, thank you for tuning in, and we will see you next week.
All right. See you guys.